By 2026, the housing downturn is no longer a prediction. It's unfolding in real time across 10 American cities, where for sale signs are no longer rare. They're clustering block by block, street after street, in neighborhoods that seemed immune just 2 years ago. Active listings nationwide have surged more than 30% from their 2024 lows, while price cuts now dominate major metros from the Mountain West to the Eastern Seaboard. Millions of homeowners find themselves exposed. Trillions in equity hang in the balance. Yet somehow, the public still hears soft landing. The brochures still promise appreciation. Mortgage advertisements still feature smiling families turning keys. The reality tells a different story entirely. This isn't just about prices falling, though they are. It's about insurance failures making homes uninsurable, tax resets crushing monthly payments beyond recognition, job volatility freezing buyers in place, and liquidity evaporating from markets that once seemed permanently desirable. Today, we're counting down from the early warning signs to the full epicenters, ending with the city everyone believed could never fall. Subscribe now for documentary-level market breakdowns, and drop a comment with the city you're watching most closely in 2026. Let's begin. In the high desert valleys of southwestern Idaho, Boise once represented everything the pandemic homebuyer wanted. Remote workers fleeing coastal costs discovered a city with mountain access, a growing technology presence, and prices that seemed almost reasonable compared to Seattle or San Francisco. Between 2020 and 2022, median home values climbed more than 50% as migration waves transformed quiet neighborhoods into competitive bidding zones. The growth felt permanent. The appreciation felt earned. But by 2026, that migration wave has reversed into something quieter and far more troubling. Prices now sit 8 to 10% below their 2022 peak, erasing years of gains for anyone who bought near the top. Inventory has climbed roughly 45% above 2023 levels, with homes lingering on the market for months instead of the days that defined the boom years. Consider the remote worker who relocated in 2021, locking into a mortgage at peak prices with the confidence that equity would continue building. That worker now watches their home's value erode, while interest rates make refinancing impossible and selling means accepting a loss. Tech sector contractions have gutted the demand that once seemed endless. The Boise dream hasn't shattered dramatically, it's deflating slowly, which may be the most troubling trajectory of all. Boise didn't crash, it stalled first. And that stillness is often the most ominous signal a market can send. From the Mountain West, the story shifts to Florida's Gulf Coast, where Tampa built its reputation as the ultimate migration magnet. No state income tax drew high earners from New York and California. Year-round sunshine attracted retirees and remote workers alike. A cost of living that undercut Miami and Orlando made the Tampa Bay region feel like a reasonable choice, perhaps even a smart one. Families arrived by the thousands, pushing prices upward and convincing developers to break ground on master-planned communities stretching deep into the suburban periphery. The growth narratives wrote themselves. But by 2026, a hidden cost has emerged that no relocation calculator anticipated, no real estate agent mentioned, and no closing document adequately prepared buyers to face. Days on market have increased roughly 60% compared to 2024, signaling that demand has softened significantly. Price cuts now appear on approximately 40% of active listings across the metro area. Yet the culprit isn't demand alone. It's the insurance crisis reshaping Florida's entire housing equation from the foundation up. Homeowners report premiums doubling in a single year, transforming manageable budgets into monthly emergencies. Some insurance policies now rival mortgage payments in their monthly cost, effectively doubling what ownership actually means. HOA fees compound the burden in communities that promised amenities but delivered assessments. A homeowner who purchased in 2021 with careful calculations now faces a total housing cost completely unrecognizable from their original budget. Florida's risk isn't cyclical, the kind of softness that recovers with the next economic expansion. It's structural, baked into geography, climate, and actuarial mathematics, and the market is finally beginning to price that uncomfortable truth. If Tampa reveals the insurance fault line running beneath Florida's growth story, then Phoenix exposes how quickly speculative momentum can reverse when conditions shift. During the pandemic housing boom, no major American metro grew faster or attracted more attention. Investors poured capital into single-family rentals, betting that appreciation and rental demand would deliver returns impossible to find elsewhere. Short-term vacation rental operators converted properties across the metro, anticipating tourist dollars that seemed guaranteed. New construction sprawled across the desert floor in every direction, with builders racing to meet what appeared to be bottomless demand. Prices doubled in some zip codes between 2020 and 2022, creating paper wealth that homeowners assumed was permanent. Now the unwinding has become impossible to ignore, rationalize, or explain away. Inventory has climbed to more than twice 2021 levels, flooding the market with options that buyers no longer feel urgency to pursue. Prices sit roughly 10% below their peak, with certain suburban submarkets showing far steeper declines that haven't yet registered in metro-wide statistics. An investor holding a vacant short-term rental watches nightly rates collapse as competition intensifies, while carrying costs, mortgage, taxes, insurance, maintenance, remain stubbornly fixed. Here's an impossible statistic that reveals the speed of this reversal. Some Phoenix suburbs have seen active listings triple in just 3 years. Triple. Street after street, identical homes sit listed with nearly identical asking prices, their for sale signs indistinguishable except for the weeks or months they've accumulated in place. Phoenix isn't merely cooling from an overheated state. It's demonstrating exactly what happens when a boom built entirely on momentum, speculation, and the assumption of perpetual appreciation loses its direction and its believers simultaneously. Tell us in the comments, which of these cities is on your radar? Which housing market are you watching most closely? And which city do you think we haven't mentioned yet that deserves a spot on this list? The warning signs in Boise, Tampa, and Phoenix might still be dismissed as isolated corrections in overheated markets, the inevitable cooling that follows any boom. But in Austin, Texas, the damage has become impossible to rationalize away, and the implications extend far beyond a single metro. For years, Austin represented the ultimate American growth story, the city that seemingly couldn't fail. Tech giants relocated headquarters, bringing thousands of high-paying jobs. Population inflows outpaced nearly every major metro in America for a decade running. The cultural scene, music, food, nightlife, attracted young professionals willing to pay premium prices for the Austin lifestyle. Between 2020 and 2022, median home prices climbed by more than 50%, as demand seemed to justify any asking price. Local boosters declared the city recession-proof, too dynamic and too desirable to ever experience a meaningful correction. The math told a different story that few wanted to hear. By 2026, median prices have fallen roughly 15% from their peak, the steepest correction among major Texas metros, outpacing declines in Dallas, Houston, and San Antonio. New build incentives have exploded as developers sitting on inventory compete desperately for a shrinking buyer pool, offering upgrades, rate buydowns, and concessions that would have seemed absurd during the boom years. Consider the tech worker who purchased in 2022, confident that Austin's trajectory would continue upward. That worker, now laid off or facing reduced hours as the industry contracts, finds themselves trapped in a home worth significantly less than their mortgage balance, unable to sell without bringing cash to closing. Income growth in Austin never matched the valuations that euphoria and cheap money created. Austin proves what every boom city eventually learns through painful experience. Growth doesn't equal stability, and sentiment can reverse faster than the fundamentals ever justified. From Texas, The pattern intensifies in a city that knows boom and bust cycles more intimately than perhaps any other in America. Las Vegas carries the DNA of the 2008 collapse embedded in its suburban sprawl. Entire master plan developments that went dark overnight. Foreclosure signs lining cul-de-sacs for miles. A cautionary tale that supposedly taught everyone involved hard lessons about speculation and leverage. The city rebuilt slowly through the 2010s, and when the pandemic boom arrived, Vegas participated fully, with prices climbing and investors returning in force. By 2026, that boom-bust DNA has reactivated with familiar symptoms. Sales volume has dropped roughly 35% year over year, a collapse in transaction activity that signals frozen market psychology. The investor share of purchases, which dominated the post-pandemic market and provided a floor beneath prices, is retreating sharply as rental yields compress and appreciation expectations turn negative. Here's an impossible statistic that sophisticated observers find particularly alarming. Cash buyers, traditionally the stabilizing force in any market correction, the buyers who can move quickly regardless of financing conditions, are exiting faster than financed buyers. When cash investors flee, it signals that even those with resources and optionality see more risk than opportunity. Consider the casino worker who stretched to buy during the boom, their qualification based on overtime shifts and tip income that seemed reliable. That worker now faces a housing payment calibrated to peak pandemic earnings while hours get cut and tourism softens across the Strip. Tourism softness ripples into income shock, and income shock transforms rapidly into forced listings as households can no longer carry what they purchased. The cul-de-sacs aren't empty yet, not like 2009, but the open house signs multiply each weekend, and the traffic through them thins. Vegas amplifies every economic signal, both positive and negative. What begins as softness elsewhere becomes severity here. The question isn't whether the cycle has turned. It clearly has. The question is, how deep this particular downturn will cut before stabilization finally arrives. If you're finding this breakdown valuable, take a second to hit subscribe. We track these housing markets month by month, analyzing the data so you don't have to piece it together yourself. The acceleration continues in Atlanta, but here, a different mechanism is crushing the affordability that once defined the metro's appeal. For years, Atlanta drew families seeking space, relative value, and economic opportunity that coastal cities couldn't offer at any reasonable price point. The metro sprawled outward in every direction, with new subdivisions promising the dream of homeownership at prices that refugees from New York, Washington, and Los Angeles found almost quaint. The growth seemed sustainable because it was built on genuine affordability, or so the narrative claimed. By 2026, that affordability narrative has inverted into something far more troubling for households who believed they'd found stable ground. Property tax assessments have climbed double digits since 2023, reflecting the rapid appreciation that preceded the current market stall. Local governments, their budgets strained, have captured that appreciation through higher assessments, even as market prices stagnate or decline. The result is an escrow shock hitting middle-income families who budgeted carefully for their mortgage payment, but never anticipated their total housing cost rising by hundreds of dollars monthly without any warning or recourse. A family that qualified responsibly in 2022, following every debt-to-income guideline their lender provided, now faces a housing cost that violates those same guidelines through no fault of their own. The hidden cost twist becomes painfully clear. It wasn't the purchase price that trapped these families. It was taxes and insurance compounding after the fact, costs that appeared nowhere in the original monthly payment calculation that convinced them they could afford to buy. Moving trucks are replacing welcome banners in subdivisions that promise suburban stability. The American dream of homeownership included assumptions about predictability that reality has systematically violated. Affordability turned into a trap, and Atlanta's sprawling suburbs are living that hard lesson in real time. The pattern deepens further as we move to Denver, a lifestyle city now meeting its own liquidity freeze at the intersection of desirability and insurability. The Colorado Front Range built its housing market on legitimate appeal: mountain access within an hour's drive, cultural amenities that rivaled coastal cities, and a booming technology and aerospace sector that provided economic foundation for premium prices. Home values climbed steadily through the 2010s, and then surged dramatically during the pandemic as remote workers sought altitude, outdoor recreation, and quality of life that seemed worth any premium. The dream of Colorado living translated into prices that reflected aspiration more than local income reality. By 2026, the math has finally broken in ways that affect every segment of the market. Listings have increased roughly 65% compared to 2022 levels, flooding a market where buyers have become cautious and financing has become expensive. Condos are leading the decline in a pattern that reveals something important about carrying costs. Prices are falling twice as fast for condominiums as for single-family homes, an impossible statistic that shows how HOA fees, special assessments, and insurance premiums have made entry-level ownership economically untenable for first-time buyers. Consider the young professional running the numbers on their first potential purchase. They discover that HOA fees, insurance premiums, special assessments for building repairs, and property taxes push monthly costs far beyond what the listing price initially suggested. The gap between sticker price and true cost has become a chasm. Wildfire risk has reshaped insurance availability across the Front Range, with some mountain-adjacent properties becoming effectively uninsurable at any reasonable rate. Carriers have exited markets entirely, leaving homeowners scrambling for coverage at any cost. The price-reduced overlays multiply on listing photos throughout the metro, each reduction representing a seller adjusting expectations to a reality they didn't anticipate when they purchased. When insurance breaks, markets stall. Denver's stall is teaching buyers, sellers, and the entire real estate industry that climate risk isn't abstract or theoretical. It's a line item on monthly statements, and it's repricing everything from mountain cabins to suburban condos. The warning signs and acceleration zones we've examined reveal a national pattern too consistent to dismiss as isolated local corrections. But the epicenters, the markets experiencing the most severe distress, show what happens when those patterns reach their logical conclusion and systemic forces overwhelm local fundamentals entirely. San Francisco and the broader Bay Area have been anticipating this reckoning for years, and in some ways, the current downturn feels like prophecy fulfilled rather than surprise. The pandemic hollowed out downtown offices as tech companies embraced remote and hybrid work. Layoffs at major employers reshaped the employment landscape that had justified astronomical housing costs. Remote work policies made proximity to headquarters optional, truly optional, for the first time in the technology industry's history. The premium for living near Silicon Valley, always justified by career necessity, suddenly needed different justification. By 2026, the numbers confirm what Bay Area residents have sensed in empty restaurants, quiet streets, and for lease signs on retail storefronts. Residential prices have declined 15 to 20% from their pandemic peak, with some neighborhoods and segments showing even steeper drops. Office vacancy exceeds 30% in the commercial core, an astonishing figure that erodes the tax base funding city services and signals that the economic engine driving housing demand has fundamentally changed. A tech worker who once competed against dozens of offers for a modest home now commutes 3 days per week to a half-empty building, wondering whether the premium they paid for proximity still makes any sense in a world where their colleagues work from Boise or Austin or Portugal. Luxury listings sit untouched for months in neighborhoods that once saw bidding wars the day properties hit the market, their price reductions stacking like geological sediment, each layer representing another month of reality setting in. San Francisco remains expensive, among the most expensive markets in the nation even after these declines. But momentum has turned decisively negative for the first time in anyone's professional memory. The city's decline was expected, even predicted by housing skeptics for a decade. But that anticipation doesn't make it less significant for the millions of people whose wealth and plans depended on Bay Area housing values. If San Francisco can't stabilize, if even this market, with its concentration of wealth and talent, continues declining, it suggests that no American market's fundamentals are strong enough to overcome the structural pressures reshaping housing nationwide. The implications ripple far beyond California's borders. Before we reveal the number one market, the one everyone believed was untouchable, take a moment to subscribe if you haven't already. You're going to want to see what comes next. If San Francisco's decline was widely anticipated among market observers, then New Orleans represents something far more troubling, a collapse that most Americans still haven't registered, a crisis unfolding in slow motion without the national attention it deserves. The city's housing dysfunction doesn't stem from tech layoffs or remote work reshaping employment patterns. It doesn't reflect speculative excess or migration waves reversing. It stems from something more fundamental and more frightening: the growing impossibility of insuring homes against the climate risks that define the Gulf Coast geography and will increasingly define American housing markets nationwide. Since 2020, insurance premiums across the New Orleans metro area have increased by 50 to 100%, with some properties seeing even more dramatic spikes. Major carriers have exited the Louisiana market entirely, unwilling to accept concentrated exposure to hurricane risk at any price. The carriers that remain have repriced policies to reflect actuarial reality, and that reality has become unbearable for middle-class homeowners who never anticipated insurance costs rivaling or exceeding their mortgage payments. Transactions are collapsing, not because buyers don't want homes in New Orleans. They do. But because lenders won't finance properties without adequate insurance, and adequate insurance has become either genuinely unavailable or utterly unaffordable for working families. Consider the multi-generational homeowner, a family that has owned their property for decades, watching their home become effectively illiquid. The house is worth something on paper, reflected in property tax assessments they can barely afford. But it's impossible to sell to any buyer requiring conventional financing because no lender will close without insurance, and no insurer will write a policy at a premium the buyer can afford. Insurance costs rivaling mortgage payments. It's an impossible statistic that redefines what homeownership actually means in this region, transforming an asset into a liability for families who did everything right. Boarded homes carry for sale signs that represent not optimism about finding buyers, but surrender to an economic reality that offers no solutions. New Orleans reveals the leading edge of a crisis that will eventually reach every coastal, flood-prone, and wildfire-adjacent market in America. The waters are rising everywhere, literally and financially. Climate risk isn't a future consideration for policymakers to debate. It's rewriting real estate mathematics today, and the consequences are measured in families who can no longer afford to stay in homes they love or sell them to anyone else. And now, number one, the market that everyone, from casual observers to professional investors, believed was permanently, structurally untouchable. New York City built its housing mythology on the bedrock of scarcity, and for decades, that mythology proved accurate enough to justify the most expensive housing costs in America. Manhattan's grid couldn't expand. The island is the island, bordered by rivers that no developer can move. Brooklyn's beloved brownstones couldn't multiply. Each one represents irreplaceable 19th century craftsmanship. The outer boroughs and suburban ring absorbed demand that the core physically couldn't meet, but the fundamental premise remained unchallenged across generations. New York would always be expensive because New York would always be desired, and desire plus scarcity equals permanently appreciating real estate. By 2026, that foundational premise is being tested for the first time since the painful post-2009 recovery that most market participants assumed was a generational anomaly never to be repeated. Inventory is surging across the outer boroughs and suburban counties, from Queens to Westchester, from Staten Island to Nassau County. Price cuts are accelerating in markets that hadn't seen meaningful concessions in a decade. The absorption rates that once cleared inventory within weeks now stretch into months. A dual-income professional family, exactly the demographic that New York housing depends upon, finds themselves chasing the market downward, watching comparable properties list for less each month, running calculations on whether waiting another quarter makes more sense than buying today, and accepting whatever depreciation follows. The dominoes falling across New York are familiar from other markets, but seemed impossible here. Mortgage rates above 6% have frozen move-up buyers in their starter homes, unwilling to trade a locked-in 3% rate for current terms. Property taxes continue their relentless climb, especially in suburban communities facing budget pressures. Remote and hybrid work has made Manhattan proximity genuinely optional for industries, finance, law, technology, media, that once demanded it absolutely. The result is the first broad-based weakness in a generation, affecting not just marginal neighborhoods, but the entire metropolitan ecosystem. Luxury units in buildings that commanded waiting lists now accumulate price reductions. Not one adjustment, but multiple cuts within a single year, each representing a seller recalibrating expectations downward toward a reality they never anticipated confronting. For sale signs appear not just in fringe neighborhoods that always experience volatility, but in enclaves that seemed permanently immune to market forces affecting lesser cities. The mythology of New York scarcity confronts the mathematics of affordability and frozen psychology, and mathematics is winning the argument. If New York can soften, not collapse, but soften meaningfully and persistently, it signals something profound: that no American market exists outside the gravitational forces reshaping housing nationwide. The city that defined real estate invincibility is discovering that invincibility was always a story, and stories change when reality intrudes forcefully enough. 10 cities, 3 tiers, one unmistakable pattern emerging from coast to coast, from mountain towns to Gulf Coast communities to the densest urban cores in America. The migration myths that promised endless demand meeting endless appreciation. The rate persistence that froze transactions and trapped homeowners in properties they can't afford to keep or sell. The insurance failures that transformed housing costs beyond recognition after purchase. The tax shocks that ambushed careful budgets calibrated to different times. And the psychological freeze keeping buyers and sellers paralyzed, waiting for certainty that may never arrive in the form they hope for. We opened with a crisis unfolding across 10 American cities. What we've traced is something more significant. A recognition phase, the moment when scattered signals consolidate into pattern, when anecdotes become data, when denial becomes untenable. The for sale signs multiplying across these markets don't represent panic, not yet. They represent liquidity failure, rational decisions made by individual households colliding with economic reality that offers no good options. The next phase of this downturn won't be driven by optimism returning, or sentiment shifting, or confidence rebuilding. It will be driven by fundamentals that no narrative can override: interest rates, employment stability, and insurability, the hard variables that ultimately determine who can afford to buy, who must sell regardless of price, and what any American home is actually worth in a market stripped of illusion. Subscribe now for what comes next. We'll be tracking every phase of this unwinding with the same documentary depth you've seen today. Drop a comment with the city you think enters freefall next. Your observations from the ground matter more than any statistic. Share this with someone who needs to see the complete picture before making their next housing decision. The brochures promised appreciation, stability, and the American dream of building wealth through homeownership. The math has delivered something else entirely. The question now isn't whether the correction continues, it's where you stand when the recognition phase ends and the next phase begins.